He communicated. Greenspan's article further warns that the failure of various risk management systems to predict the credit squeeze will prompt an unexpected and sharp, discontinuous response. An unexpected and sharp, discontinuous response. What does that phrase mean? Let's examine it carefully. Unexpected and sharp, discontinuous response. No less than Alan Greenspan is saying that the market drop will be unexpected, i.e., surprise. He says it will be sharp, which means dramatic. And he says it will be discontinuous, which means the markets will gap downward dramatically. Think of a line tracing the price of a stock or of a market. Discontinuous means that the line breaks and starts again at a much lower level. Bear Stearns was $191 last February. Monday morning it was $2. Last Friday it was $30. First trade Monday morning was right around $2. That's a discontinuous response. An unexpected and sharp, discontinuous response reminds me somewhat of how nuclear engineers describe a meltdown. A meltdown is not a meltdown. It is known in engineering parlance as a super prompt, critical excursion. Similarly here, a crash is not a crash. Rather, it is an unexpected and sharp discontinuity. This isn't me talking. It's Alan Greenspan from Monday, March 17th in the Financial Times. Does he know something we don't? Does Goldman Sachs know anything that we need to know, as discussed in video 2 of this series? Indeed, in the financial markets, there are clear analogies to nuclear meltdowns. Consider Bear Stearns. A little more than a year ago in February 2007, its stock price was $190. This last Monday, it was $2 per share. That's a meltdown at a primary dealer at the heart of the financial system. Interconnected with everybody else, a massive hyperdeflationary shock. The Fed's job last weekend was to contain that meltdown, contain that hyperdeflationary shock. Recall that Bear Stearns is a primary dealer in government securities. We can't afford many more of these episodes, striking at the very heart of the financial system. The Bear Stearns episode reminds me of the Chernobyl nuclear disaster in the 1980s. That came very close to being an absolute catastrophe, causing millions of excess deaths in Europe and Ukraine over a period of years. What actually occurred after Chernobyl was only a handful of deaths and elevated cancer cases, a far better outcome than the worst case scenario. But it was a very close call indeed, and a very high stakes game with millions of lives at stake. Similarly, at 3 Mile Island, the containment vessel in the reactor contained a 9-foot expanding bubble that threatened an imminent, super prompt, critical excursion, i.e. a meltdown. All of the mathematical projections, all the mathematical models, whether you were pro-nuclear power, whether you were anti-nuclear power, it doesn't matter. Every mathematician agreed at the TMI crisis, before the TMI crisis, the largest size bubble you would ever find in a containment vessel was 1/4 of an inch. 1/4 of an inch. Instead, what we were faced with at the time was a 9-foot large bubble, and it was expanding rapidly. Our models were blown away, and we had to rely on new postulates from those same mathematicians to guide us. They say, trust us with their calculations. We are told these financial catastrophes are 12 standard deviations from the norm, occurring only once every several million years. Yet we had the crash of 1987, the Asian and Russian meltdown in 1998, and now this. Every 10 years we are experiencing these super prompt critical excursions, and each one is dramatically worse than the one previous. We need more regulation, more inspection of these banks, not less. It's by no means clear that we are out of the woods yet, not at all. House prices continue to plummet, which is the accelerant, the gasoline on the fire. The patient is in the intensive care unit, but the patient moved his hand a few times. He's still in intensive care, however. After President Bush kept insisting that Brownie's doing a heck of a job after Hurricane Katrina, his aides finally put together a DVD for him to watch of the wretched magnitude of that disaster. That awoke him from his lengthy slumber. Someone needs to make another DVD for President Bush. After Chernobyl and 3 Mile Island, every single nuclear reactor in the world underwent an exceptionally thorough reevaluation of its basic design methodology, and many types of nuclear reactor designs were discontinued. These should be warnings to us all, just like they were in the nuclear power industry. We better get organized. We better cut back on the excessive leveraging. We need to redo our mathematical models that say these events only happen once every 300,000 years when they're happening repeatedly every 10 years, and each one is worse than the one before. We need to re-examine the mathematical models, the assumptions on which they're based. Consult the work of Nick Taleb on the black swan and random influences in the market for more information on that. We, just like we inspected all the nuclear reactors in the world after Chernobyl and 3 Mile Island, we need to inspect the books, the derivatives operations, what Warren Buffett calls the weapons of mass destruction in the financial sector. And we need to examine their risk assessment models, and some of them just aren't worthy of being permitted. And we need more regulation, not less. Imagine after 3 Mile Island and after Chernobyl, if we decided to completely deregulate the nuclear power industry after those 2 red flags. How silly would that have been? After these repeated financial crises that are completely outside the norm of what we were told would occur, according to the predictions of these models, we need to re-examine what we're doing. We need more regulation by people who know, rather than blind trust in mathematical models that are frankly false. And we need to cut back on our excessive leveraging. Bear Stearns at 30 to 1, Carlyle Capital at 30 to 1. We learned from the 1929 crash that when people bought the stock on 5% margin, that was a critical factor in the collapse of the market in 29, because you could lose a lot more than your initial investment very, very quickly. But the bond and the derivatives markets are much bigger than the stock market. Even though you now have to put up 50% margin for stocks, the Glass-Steagall regulation of 1932, responding to a public outcry, made sure of that. In the bonds and derivatives markets, they're still trading at 30 to 1. That's where we need to act. We need to raise the margin requirements for these people, increase the tail, as the haircut as it's called. I'm Mr. Fed, and that's the way it was.